Here is something that will completely dismantle and reconstruct how you think about trading success. The average retail day trader executes approximately 150 transactions per month. That is roughly 7 to 8 trades per day. And the data tells us that this average trader loses money consistently, often blowing their entire account within 90 days. Meanwhile, the most profitable individual traders in the world, the top 1%, make fewer than 20 trades in that same time frame. They sit on their hands for days, sometimes weeks at a time. Yet, they consistently generate returns that outperform the market. What is the difference? It is not intelligence. It is not capital. It is not access to Bloomberg terminals or insider information. It is something far more fundamental, something that most traders hear about but never actually master because it goes against human nature. Today I am going to reveal why patience isn't just a virtue or a helpful tip in trading. It is literally the most powerful, quantifiable edge you can develop. By the end of this session, you will understand exactly how to weaponize patience to transform your trading results while everyone else frantically chases every green or red candle on their screen. But before we get into the how, we need to look at the hard data. This isn't just opinion, this is statistical fact. Researchers at the University of Chicago conducted a massive analysis of over 66,000 trading accounts over a 5-year period. They were looking for the common denominators of success. What they discovered stopped me in my tracks. They found that traders who reduced their trading frequency by just 50% increased their net returns by an average of 87%. Think about that specifically. By doing half the work, they earned almost double the profit. In what other profession does that equation exist? If you work half the hours at a construction site, you get half the pay. If you write half a book, you don't get paid. But in trading, the less you do, the more you make. This phenomenon exists because of the mathematics of transaction costs and probability. Every time you enter a trade, you are paying a spread, you are paying a commission, and you are exposing yourself to slippage. These are the hidden taxes of trading. If you trade 150 times a month, you are paying that tax 150 times. You are starting every single trade at a loss that you have to climb out of just to break even. But there is a deeper mathematical reality here, the recovery fallacy. Let's look at the math of drawdowns. If you are an impatient trader and you lose 10% of your account in a bad morning of overtrading, you need an 11% gain just to get back to zero. That doesn't sound too bad. But if you continue to spiral, driven by impatience, and you lose 50% of your account, the math changes drastically. You now need a 100% return on your remaining capital just to break even. Patience is the only defense against this mathematical trap. The patient trader never digs that hole. Yet, somehow, the entire retail trading industry is designed to make you do the exact opposite. Every platform notification, every flashing price alert on your phone, every social media guru posting their latest 1-minute scalp is engineered to trigger your impulse to act immediately. The industry is built on churn. Brokers make money when you trade, not when you win. They profit from your impatience. But what if I told you that the most successful traders, the whales, the hedge fund managers, the legends, do something completely different? What if the real edge isn't in finding more opportunities, but in having the extreme discipline to ignore 99% of them? Let me paint you a vivid picture of 2 traders to illustrate this. First, we have Sarah. Sarah sits at her desk each morning at 8 a.m. She reviews her watch list of 5 specific assets. She identifies 3 potential setups based on a strict set of criteria she has backtested for 2 years. And then she waits. The market opens. Candles start moving. Prices fluctuate. But Sarah does nothing. Her criteria have not been met. 10 a.m. comes and goes. Nothing. No, nothing. At 2 p.m. she sees a setup forming, but it lacks one volume confirmation. She does not click the button. She closes her laptop at 4 p.m. having made 0 trades. To the outside observer, Sarah did nothing today. She was unproductive. But Sarah knows she just saved herself money. She averages 18 trades per month and maintains a 64% win rate. Then we have Jake. Jake is glued to his screens from the pre-market open to the closing bell. He has 4 monitors. He is watching the 1-minute chart, the 5-minute chart, and the 15-minute chart simultaneously. His finger is hovering over his mouse, ready to pounce on any momentum shift. At 9:35 a.m. he sees a green candle and buys. It reverses. He sells. He sees a drop and shorts it. It rallies. He buys again. He feels productive. He feels engaged. He feels alive. He feels like a trader. He averages 140 trades per month with a 41% win rate. On paper, Jake seems more dedicated. He is putting in the grind. Sarah appears lazy by comparison. She spends most of her day reading, analyzing, or simply walking away from the screen. But here is what the numbers reveal after 6 months. Sarah's account is up 34%. Jake's account is down 18%. They traded the same market conditions. They traded the same time period. They had access to the same news. The difference wasn't luck. It wasn't skill in technical analysis. It wasn't even strategy. It was patience. Sarah understands something that Jake doesn't. Markets reward surgical precision, not frantic activity. She has learned to distinguish between being busy and being profitable. Jake confuses motion with progress. This pattern repeats everywhere you look in professional trading. Look at Berkshire Hathaway. Warren Buffett and Charlie Munger sit on billions of dollars of cash, sometimes for years, doing absolutely nothing. They are waiting for the fat pitch. They have famously said that if you only had a punch card with 20 slots for 20 investments in your entire lifetime, you would be incredibly wealthy because you would be forced to be patient. Now you might say, but I'm a day trader, not Warren Buffett. I need to be active. Even in day trading, patience creates compound advantages that most people never recognize. Let's look at the logic of market structure. If you are taking 150 trades per month, you are essentially stating that the market provides 150 high-probability opportunities every single month. That is more than 7 A-plus setups every single trading day. Ask yourself honestly, does that sound realistic? Are there really 7 moments every single day where the institutional money, the volume, and the technicals align perfectly to virtually guarantee you a profit? Of course not. What is actually happening is that impatient traders are lowering their standards. They start the day looking for an A-plus setup. But after 2 hours of boredom, they start accepting B-minus setups. By lunch, they are trading C-grade garbage because they crave the dopamine hit of being in a trade. They are trading their boredom, not their edge. Patient traders understand a fundamental truth about market behavior. Markets spend roughly 80% of their time in consolidation, in chop, in noise. Only about 20% of the time does the market engage in clear, directional moves where substantial profits exist with low risk. The impatient trader tries to extract money from the 80% of noise. The patient trader waits for the 20% of clarity. Let's break down the mathematical advantage this creates. Let's say both Sarah and Jake risk 1% of their account per trade. Sarah takes her 18 carefully selected trades. Because she waits for the fat pitch, her stop losses are tighter and her targets are clearer. She averages a 1.8 to 1 risk-to-reward ratio. Even with a modest win rate, the math guarantees she grows her account. Jake, forcing trades in the noise, takes 140 trades. Because he is trading in choppy conditions, he gets stopped out frequently or takes quick profits too early out of fear. His risk-to-reward ratio drops to 1 to 1 or worse. The commissions alone eat him alive. But here is where it gets really interesting. The psychological benefits of patience extend far beyond just better trade selection. We need to talk about the neuroscience of trading. When you are patient, you are operating from the prefrontal cortex of your brain. This is the executive center. It handles logic, risk assessment, future planning, and emotional regulation. It is the CEO of your brain. When you are impatient, when you are chasing price, when you are revenge trading, you shift activity to the amygdala. This is the primitive part of the brain. It is the fear and fight or flight center. Here is the scary part. Neuroscientists have found that financial losses process in the brain in the exact same location as physical pain. When you lose money, your brain reacts as if you have been punched in the stomach. So, when Jake takes 5 bad trades in a row because he is impatient, he is subjecting his brain to repeated physical trauma stimuli. His prefrontal cortex shuts down. His amygdala takes over. He literally becomes incapable of making rational decisions. He is now trading on pure survival instinct, which tells him to get the money back now. This is how accounts go to zero in a single afternoon. Conversely, Sarah, by trading less, protects her mental capital. She maintains psychological equilibrium. When she does enter a trade, her brain is calm. It is in an optimal state for pattern recognition. She isn't fighting the market, she is observing it. Patience is not passive waiting, it is active preparation. This is a crucial distinction. While the impatient trader is clicking buttons, what is the patient trader doing? They are studying market structure. They are analyzing institutional flow. They are marking out key liquidity levels on higher time frames. They are reading economic calendars to understand the catalysts for the week. They are loading the chamber. When that specific opportunity finally arrives, that moment where the technicals align with the fundamentals and the volume, Sarah is ready. She has been preparing for this specific moment for 3 days. She strikes with conviction. She sizes up. She doesn't hesitate. Jake, meanwhile, is exhausted. He has been fighting the choppy market for 6 hours. He is mentally depleted. When the real move finally happens, he misses it. He is either stuck in a bad counter-trend trade he entered 10 minutes ago, or he is too scared to pull the trigger because he has already lost 3% of his account that morning. The impatient trader is so busy reacting to noise that they cannot hear the signal. Let's look at how the professional side of the industry operates, the prop firms and the hedge funds. These firms manage billions in capital. They have entire departments dedicated to risk management. Do you think they hire traders based on who can click the mouse the fastest? No. They evaluate traders based on risk-adjusted returns and consistency. If you look at the data from modern prop trading firms, companies that fund retail traders, the statistics are revealing. The traders who pass the evaluation challenges and, more importantly, the traders who keep the funded accounts for more than 3 months, share one specific trait: low trade frequency. Prop firms put strict drawdown limits on accounts, usually 5% or 10%. If you lose that, you are out. This structure is designed to force patience. If you are trying to make a 10% profit target while avoiding a 5% loss, every single bullet counts. You cannot afford to fire wildly into the bushes. Traders who treat trading like a video game fail these challenges 95% of the time. Traders who treat it like a sniper mission pass. This brings us to the concept of the sniper versus the machine gunner. The machine gunner sprays ammunition everywhere, hoping to hit something. They make a lot of noise. They feel powerful, but they waste resources and reveal their position. In trading, the machine gunner is the scalper who takes 30 trades a day, paying massive commissions and suffering from decision fatigue. The sniper lies in the grass for 3 days. They don't move. They monitor the wind. They monitor the distance. They wait for the target to step into the crosshairs. One shot. One kill. The market rewards the sniper. Why? Because the sniper is operating in alignment with how the smart money moves. Let's talk about smart money concepts and liquidity. This is technical, but it is essential to understanding why patience pays. Institutional algorithms, the programs that run the markets, need liquidity to fill their massive orders. If a bank wants to buy $500 million worth of euro/dollar, they cannot just click buy. The price would skyrocket instantly, and they would get a terrible entry. So what do? They wait. They wait for liquidity to build up. Where does liquidity live? It lives at the obvious highs and lows where impatient retail traders place their stop losses. The institutions wait for the retail traders to get impatient. They wait for Jake to short the market because it looks weak. Then the algorithm pushes price up just enough to trigger Jake's stop loss. That buy order from Jake's stop loss provides the liquidity the bank needs to fill their sell order. The market is an impatience transfer mechanism. It transfers money from the impatient to the patient. When you rush into a trade, you are usually becoming the liquidity for someone else who was patient enough to wait for you to make a mistake. Patient traders see the market differently. They don't see it as a monster to be slain. They see it as a river to be navigated. Impatient traders try to force the river to flow upstream. They try to make the market give them money. I need to make $500 today to pay rent, they say. The market does not care about your rent. The market does not care about your goals. Patient traders, however, flow with the river. They ask, what is the market offering me today? Sometimes the answer is nothing. And here is the hardest lesson to learn. No position is a position. Being flat, cash, is a valid trading position. In fact, during high volatility news events or unclear ranging markets, cash is the most profitable position you can hold because you are preserving your capital while others are setting theirs on fire. Let's talk about how to actually implement this. How do we weaponize patience? How do we go from being Jake to being Sarah? It requires a complete restructuring of your reward system. You have to stop measuring your success by how much money you made today. That is a lagging indicator. You need to start measuring success by process adherence. Here is a practical exercise. Create a patience scorecard. Give yourself points for every hour you sit on your hands when your setup isn't there. Give yourself points for walking away from the screen when the market is choppy. Give yourself points for ending the day with 0 trades if the market didn't offer a setup. If you finish a day with 0 trades and 0 losses because you followed your rules, that is a winning day. You need to wire your brain to release dopamine for discipline, not for action. Furthermore, you need to understand the 4 stages of competence in trading. Stage 1 is unconscious incompetence. You are impatient, you are losing money, and you don't even know why. You think the market is rigged. Stage 2 is conscious incompetence. You realize that your impatience is killing you. You see the problem, but you can't stop yourself yet. This is the most painful stage. Stage 3 is conscious competence. You can be patient, but it takes extreme effort. You have to physically restrain yourself from clicking the mouse. You are white-knuckling it. Stage 4 is unconscious competence. This is where the masters live. Patience becomes effortless. You look at a bad chart and you feel nothing. You feel no urge to trade. You are like a predator who isn't hungry. You only hunt when the prey is limping and the wind is at your back. How do you get to stage 4? You get there by trusting the law of large numbers. If you have a trading edge, let's say a strategy with a 60% win rate, you don't need to force trades today. The math will play out over the next 100 trades. If you miss a trade today, it doesn't matter. There will be another one tomorrow or next week. The market isn't going anywhere. Impatient traders operate from a scarcity mindset. They think, if I don't catch this move, I'll never make money. Patient traders operate from an abundance mindset. They know the market is an endless stream of opportunities. If you miss the bus, another one is coming in 10 minutes. But if you get hit by the bus trying to chase it, you are out of the game forever. Let's look at the compounding effect of patience over a 5-year horizon. Let's assume 2 traders start with $10,000. Trader A, impatient, aims for 10% a month but suffers frequent 20% drawdowns due to overtrading. He spins his wheels. He makes money, gives it back, makes money, gives it back. After 5 years, he is likely still scratching around break-even, or he has quit entirely. Trader B, patient, targets a modest 4% per month. Just 4%. But because she is patient, she avoids the massive drawdowns. She compounds. Do you know what $10,000 turns into at 4% compounded monthly for 5 years? It turns into over $105,000. That is a 10x return. But wait, let's go out to 10 years. That same conservative, patient 4% monthly return turns that $10,000 into over $1.1 million. This is the secret the get-rich-quick gurus don't tell you. The speed of your wealth generation is directly correlated to the slowness of your decision-making. Fast trading leads to slow growth. Slow, deliberate trading leads to exponential growth. Now, consider the lifestyle difference. The impatient trader is chained to the screen. They are stressed. Their cortisol levels are through the roof. They are ignoring their family. They are dreaming about charts. They are miserable even when they are winning. The patient trader has freedom. They check the charts for specific windows of time. If there is nothing to do, they go to the gym. They read a book. They live their life. Trading is a tool to support their life, not a master that enslaves it. When major market events hit, like a Federal Reserve interest rate decision, the difference in approach is stark. When the news drops and the candles start whipping back and forth, the impatient trader dives in. They see the volatility as a playground. They get whipsawed. They get stopped out on the wick down, then they panic buy on the wick up, only to get crushed again. The patient trader sits back. They wait for the dust to settle. They wait for the initial amateur reaction to finish. They wait for the institutional trend to reveal itself, usually 30 to 60 minutes after the news release. Then they enter safely in the direction of the real flow. It is the difference between running into a burning building and waiting for the fire to be put out before walking in to collect the gold. So here's your challenge. Here is how you change your trading life starting tomorrow. I want you to cut your trade volume in half. If you usually take 4 trades a day, you are now allowed 2. If you usually take 10 trades a week, you are now allowed 5. Force yourself to filter. If you have 2 okay setups, you take neither. You only take the one that is screaming at you. Start keeping a feelings journal alongside your trading journal. Before every trade, write down how you feel. Are you bored? Are you excited? Are you scared of missing out? If you write down, I'm bored, or I need to make back my loss, you must physically stand up and walk away from the computer. You will find that your account balance will stabilize. The bleeding will stop. And once the bleeding stops, the growth can begin. Remember the University of Chicago study. Doing 50% less can lead to 87% more. Your edge is not your indicator. Your edge is not your trend line. Your edge is your ability to do nothing when everyone else is losing their minds. The market is a device for transferring money from the impatient to the patient. Decide today which side of the transaction you are going to be on. In this game, the tortoise doesn't just beat the hare. The tortoise owns the casino. Stop chasing. Start waiting. And watch how everything changes.